This is John. He's 58 years old, works at a manufacturing plant in Ohio, has been contributing to his 401k for 31 years straight. Every single paycheck. Never missing a contribution, never pulling out early, doing everything the financial advisors in the personal finance books and the responsible adult conventional wisdom told him to do. And last Tuesday, without a single phone call, without a single email, without anyone asking for his permission or his opinion, his retirement fund bought SpaceX stock. Not because John believes in Mars colonies. Not because John thinks humanity needs to become a multiplanetary species. Not because John has ever once in his life looked at a rocket launch and thought, yes, I want my life savings tied to that. John found out the same way most Americans find out about these things, buried in a quarterly statement that nobody reads until it's too late. And here's the part that should make your blood boil. John is not alone. Millions of Americans, right now, today, own SpaceX stock at what analysts are calling peak hype valuation. And they didn't choose it. Their fund managers chose it. The index chose it. The system chose it for them. And the system, as we are going to show you today, has a very long and very ugly history of making choices that benefit Wall Street and devastate Main Street. If you are new here, welcome to Finance Stories, the channel that pulls back the curtain on the financial decisions being made with your money while you are busy living your life. Hit that subscribe button right now, because what we are covering today is the kind of story that the financial press will spend 6 months tiptoeing around, and we are going to cover it in the next 13 minutes. Subscribe, turn on notifications, and let's get into it. So let's start with the hype, because you cannot understand the danger without first understanding the seduction. SpaceX, officially Space Exploration Technologies Corporation, is the brainchild of Elon Musk, and depending on which version of Elon Musk you believe in on any given week, it is either the most important company in the history of human civilization or an expensive hobby funded by government contracts and venture capital optimism. The company has been valued in various private funding rounds at numbers that would have seemed like a typo 10 years ago. We are talking about valuations that crossed the $1 trillion threshold, a number so large that it belongs in the same conversation as Apple, Microsoft, and Nvidia, companies that have decades of audited public earnings, established revenue models, and actual profit margins that you can look at and evaluate. SpaceX, on the other hand, is selling you something slightly different. SpaceX is selling you the future, and not just any future. The full science fiction package Mars colonies, a self-sustaining civilization on another planet within our lifetime. Data centers operating from orbit, Starlink satellites blanketing the Earth in high-speed internet, connecting the most remote corners of the planet, and, not coincidentally, generating the kind of recurring subscription revenue that makes Wall Street analysts weak in the knees. Reusable rockets that land themselves back on drone ships in the middle of the ocean like something out of a movie that your kids watch on a Saturday morning. And look, if we are being honest with each other, and that is the entire premise of this channel, some of this is genuinely impressive. The engineering achievements at SpaceX are real. The Falcon 9 reusability record is real. Starlink's growth is real. We are not here to tell you that SpaceX is a fraud in the conventional sense, that the rockets do not fly or the satellites do not work. We are here to tell you something much more specific and much more dangerous. We are here to tell you that the difference between an impressive company and a correctly priced company is the difference between a great story and a great investment. And Wall Street has been deliberately, systematically, and very profitably confusing those two things since long before any of us were born. Sounds like science fiction? Sure! But your pension is paying for it. Now let's talk about the mechanism, because this is where it gets really interesting. And by interesting, I mean infuriating. And by infuriating, I mean the kind of thing that you bring up at Thanksgiving dinner and everyone tells you to relax and you cannot relax because you understand what is actually happening. When a company goes public, entering the major indexes, the S&P 500, the Nasdaq 100, the indices that your passive investment funds are literally designed to mirror requires meeting certain criteria. These criteria exist for a reason. They exist to ensure that the companies being included in the most widely held investment vehicles in the world are actually established, stable, and financially sound enough to warrant that kind of universal exposure. There are profitability requirements. There are liquidity requirements. There are seasoning periods, lengths of time a company must trade publicly before being considered for inclusion. These rules are not arbitrary bureaucratic obstacles. They are the guardrails that are supposed to protect ordinary investors from being force-fed speculative assets inside what are supposed to be relatively safe, diversified investment products. And then SpaceX came along. And Nasdaq looked at those guardrails and apparently decided that for the right company, or perhaps the right valuation, or perhaps the right amount of cultural momentum and media attention, some of those guardrails are more like gentle suggestions. The speed with which SpaceX moved through the process of qualifying for Nasdaq 100 inclusion raised eyebrows among serious market observers. The standard timeline was compressed. Criteria that would have disqualified other companies were evaluated differently when applied to space, and the result was that a company with SpaceX's particular financial profile, significant ongoing capital expenditures, a revenue model that is still maturing, and a valuation priced for a version of the future that has not happened yet, landed inside the Nasdaq 100 faster than the rules were ever designed to allow. Why does that matter to you personally? Because of how passive investing works. When a company enters the Nasdaq 100, every fund that tracks it must buy that stock. Not because any fund manager evaluated SpaceX and decided it was a good investment at the current price. Not because anyone ran the numbers and concluded the valuation was justified by the fundamentals, but because the index changed. So the fund changes, and the fund is where your retirement money lives. Pangzong funds, the old-fashioned kind, the defined benefit plans that still exist for teachers, firefighters, municipal workers, and some union employees. Many of these funds have mandates requiring them to hold certain percentages of large cap index components. When SpaceX enters the index at $1 trillion plus valuation, these funds are not given the option to wait and see, to buy at a lower price if the market corrects, to exercise the kind of valuation discipline that any rational investor would want to apply before committing this much capital to this much uncertainty. They buy at whatever the price is, on whatever day the index. Your retirement account is now Elon Musk's safety net. It is the flaw under SpaceX's valuation. Even if sophisticated institutional investors decide the price is too rich, the stock has a permanent base of buyers who are structurally required to hold it. That is not a market. That is a captive audience. And you are the captive. If you are still watching at this point, and if you are exactly the kind of person this channel exists for. Do me a favor right now. Hit the like button on this video. Leave a comment below telling me whether you knew that your index fund could buy stocks like this without your input. I read every single comment, and I want to know how many people watching this had no idea this was happening inside their retirement accounts. Share this video with one person in your life who has a 401k and has never once thought about how index inclusion works. That person needs to see this. That is how Finance Stories grows. And that is how more people get access to information that Wall Street would prefer stayed complicated and confusing. Hit like, drop a comment, and let's keep going. Now, if you are sitting there thinking that this sounds familiar, that vague, uncomfortable feeling that you have heard this story before, that the specific details are different, but the shape of the thing, the structure of the risk, the way ordinary people end up holding the bag for sophisticated investors who got in earlier and at better prices, if that feeling is creeping up the back of your neck right now, trust it, because we have absolutely seen this movie before, and it did not end well. Cast your mind back to 2008, not to the collapse itself, but to the years before it, to the period when mortgage-backed securities were being packaged and rated and sold and resold throughout the financial system, embedded in products that pension funds and retirement accounts held because they were supposed to be safe, because they had the ratings. The underlying assets, The mortgages themselves were of deeply questionable quality. The valuations were built on assumptions about real estate prices that turned out to be catastrophically wrong. But by the time anyone with fiduciary responsibility actually questioned those assumptions, the exposure was already system-wide. The risk was already distributed. And when the correction came, it came for everyone, including everyone who had never made a single speculative decision in their financial lives, who had simply been doing the responsible thing and contributing to their retirement accounts. Trillions of dollars in household wealth evaporated. Retirement timelines extended by years. People who planned to retire in 2008 or 2009 worked until 2012 or 2013 or later if they could find work at all. Or go international and look at the Saudi Aramco IPO in 2019. The largest IPO in history at the time, a valuation of $2 trillion, built partly on a number that served political and budgetary purposes for the Saudi government. Aramco spent years trading below its IPO price internationally. Early investors who bought into the hype at peak valuation spent years underwater. The pattern is not subtle. Massive valuation, compressed entry into mainstream investment vehicles. Ordinary investors absorbing exposure at prices already set by earlier, more sophisticated capital. Then the long painful process of price discovery. We have seen this movie before, and it did not end well. Now let's go deeper, because the SpaceX story has layers that most financial coverage is not spending enough time on, and these layers are where the real anger lives. Let's talk about X. Elon Musk's artificial intelligence company has been burning through capital at a rate that is extraordinary, even by AI startup standards. The compute costs, the talent costs, the infrastructure cost of trying to build a competitive large language model from a standing start while competing against companies that had years of head start and billions in established infrastructure. These are not small numbers. These require continuous infusions of fresh capital. Where does that capital come from? The connections between Elon Musk's various enterprises are not always as cleanly separated as the corporate structure diagrams would suggest. There have been transactions and capital flows between entities in the Musk ecosystem that have raised legitimate questions among governance experts and minority shareholders. Questions about whether the interests of one company's shareholders are being subordinated to the needs of another company that happens to share an owner. Tesla is the clearest example. Tesla shareholders watch their company become entangled in decisions and directions that reflect Elon Musk's personal priorities and portfolio needs, rather than what a straightforward analysis of Tesla's optimal path would suggest. There were shareholder votes, proposals that failed to win majority support from independent shareholders, and yet the decisions moved forward because the duly class share structure, the corporate governance mechanism that gives the founder voting power, disproportionate to his economic ownership, means that even when shareholders said no, Elon said yes. Even Tesla shareholders said no, but Elon said yes. And this is the structure now embedded in SpaceX's public offering. The pension funds and index funds and 401k accounts required to hold SpaceX stock have bought an economic interest in a company over which they have, practically speaking, no meaningful governance voice whatsoever. They get the downside. They do not get the vote. They are passengers on a ship where they have no say in their navigation, and the captain has a well-documented tendency to make decisions based on factors that extend well beyond the interests of any single enterprise. So let's bring this to a point. Let's make this concrete and immediate and visceral. This is not a rocket to Mars. What SpaceX's entry into the major indices at $1 trillion plus valuation actually is a financial time bomb strapped to your 401k. It is a mechanism by which the risk of an extraordinarily ambitious, capital-intensive, long-timeline speculative bet has been distributed without meaningful consent through the quiet operation of index mechanics to the retirement savings of ordinary Americans who were told that index investing was a safe, responsible, boring choice. The choice that financial advisors recommend. The choice that every personal finance book published in the last 20 years has endorsed as the sensible alternative to stock picking and speculation. And now that choice contains SpaceX at peak hype. with no governance rights, with rules that were bent to make the inclusion faster than the standard process would have allowed, with a valuation that requires a very specific, very optimistic version of the future to justify, with an owner whose attention, resources, and decision-making are distributed across a portfolio of companies and political activities that may or may not align with the interests of your retirement account. The moment of maximum danger in any bubble is not when prices are falling. It is right now, when the story is still compelling, when the headlines are still positive, when the cultural momentum is still overwhelmingly in one direction. The people who got hurt in 2008 did not get hurt because they failed to act during the collapse. They got hurt because they were not warned in the period before the collapse, when the signals were present, but the dominant narrative was still confidence and growth and endless upward momentum. The signal is present now. The valuation gap between what SpaceX is priced at and what its current, auditable, cash flow generating businesses can justify is the signal. The speed of index inclusion is the signal. The governance structure that protects the founder's control at the expense of minority shareholder interests is the signal. The connections to other enterprises with their own capital needs is the signal. None of these signals guarantee a crash. Markets can stay irrational for longer than any of us expect, but the signals are there, and you deserve to know that they are there. The SpaceX bubble is not just about Elon Musk. It is about how Wall Street rewrites the rules while Main Street pays the price. It is about how the mechanisms of passive investing designed to democratize access to markets, to give ordinary people a fair shot at participating in economic growth, have become mechanisms for distributing the risk of speculative assets to people who did not choose that risk and did not consent to that exposure. It is about how corporate governance structures concentrate power in the hands of founders and allow decisions to be made that serve founder interests rather than shareholder interests. And it is about the gap between the story that markets tell about themselves, efficient, rational, fair, protective of individual investors, and the reality, which is messier and more political and more dependent on who has the leverage to rewrite the criteria when the standard criteria produce inconvenient results. Open your quarterly statement. Find out what your fund holds. Understand how assets get into your retirement account. Demand clarity from the people who manage that account on your behalf. Because the alternative, assuming the system is working the way it is supposed to work, that someone else is watching out for your interests, has a very well-documented historical track record, and it does not end well. For legal reasons, everything you just heard is the rant of a deeply paranoid investor with too much time and not enough faith in the invisible hand of the free market. This is not financial advice. Consult a licensed professional before making any investment decisions. We are legally required to say that. We are also morally required to point out that if your pension drops 30% in the next 18 months, maybe paranoia was just pattern recognition that made people uncomfortable. If this video made you think, if it made you angry, if it made you want to check your retirement account for the first time in months, then do 3 things for me right now. Like this video. Leave a comment below with one word describing how you feel about your 401k after watching this. And subscribe to Finance Stories if you are not already here, because this is the kind of content we make every single week, pulling back the curtain, following the money, and refusing to pretend that complicated is the same as unknowable. And when you are done here, the next Finance Stories video is appearing on your screen right now. Watch it, because the story we just told you about SpaceX connects to a much larger story about how retirement in America actually works and who it actually works for. That video is next. We will see you there.